Okay, well, you're jumping in at the beginning of the lecture, so better than hearing me do a commercial for the first 5 minutes. So, oh well, you haven't missed much if the recording has just started. We're just talking about the components of a bond, and then we're going to be talking about the relationship of interest rates to bond prices, interest rate risk, and credit risk. Okay, so let's try one. Let's try our first test question. Let's try our first practice question. Are you here, Cynthia? Cynthia, did you join us on this one? I don't know if Cynthia did. Cynthia asked, oh, there's Cynthia. She's stuck in the waiting room. Okay, welcome, Cynthia. So, Cynthia, I just was looking for you. And the reason I was looking for you is because you had asked for me to incorporate practice questions into these evening, late afternoon classes, and I have done so. And we got off to a late start here. Well, on time start, but we just now started recording. So you just missed Cynthia, not much. But here's an example of a test question or practice question, if you will. You know, we're going to be talking about the current yield of a bond. You can't be fumbling around with current yield. You're going to have to be able to crunch that. We're going to be talking about the bond's basis. That's the fancy word for yield to maturity. We're going to be talking about the bond's yield to call, and we're going to be talking about the nominal yield. But as we said, the one yield that doesn't change is the coupon. Ford says they don't care who's got the bonds, that's what they're paying. And so indeed, the answer is D. The answer is D. Does not fluctuate. All right, so the game they make you play on the test, is they give you a yield and they make you come up with a price. Or they give you a price and they make you come up with the yield. Now, I am a big fan of the teeter-totter or seesaw. And the reason I'm a big fan of the teeter-totter or seesaw is because it turns judgment questions into aim and shoot, point and click questions. And so what I'd like to illustrate you first is this flat line. And the flat line represents a bond at par. We do have to be able to crunch a bond's current yield. And what I want to illustrate to you is that when you buy a bond at par, all of these yields are the same. All of these yields are the same. Current yield is very testable. Current yield is what an investment pays you divided by what it costs you. What an investment pays you divided by what it costs you. And so to get the current yield here, we would take $80 and we would divide by what it costs us, which is par. And I have indeed illustrated that when we buy a bond at par, the current yield and the nominal yield are the same. That's our current yield. We have to be able to do that on the test. Now, if I buy the bond at par, and it matures at par. In other words, in the primary transaction, lend Ford $1,000. And I hold it to maturity and Ford gives me back $1,000. I haven't made or lost any money to maturity. All I've made is 8%. You know, if Ford calls the bonds in 5 years at par, so I lend Ford $1,000 and they call it away from me in 5 years at par, I've made 8%. So here's the game they're going to make you play on the test, and we'll play it first with a bond at par. This game is called not testable, called interpolation. So I tell you on the test that you're considering purchasing a bond that has a yield to maturity the same as the coupon. You're considering buying a bond that has a coupon the same as the yield to maturity. Are you considering paying par $1,000? Are you considering paying a premium? Are you considering paying a discount? Cannot be determined. Don't ever take the cannot be determined choice. It is never correct. So a bond has a yield to maturity the same as the coupon, or a bond has a coupon the same as the yield to maturity. Is the bond priced at a premium, par, discount? Cannot be determined. Now, what I like is with our teeter-totter, we can see here that is a bond priced at par. And again, that's something we're going to make us play on the test, this game called interpolation. And remember, the fancy word for yield to maturity is the bond's basis. Okay, let's try the other version of this. Your customer buys a bond at par. Is your customer's yield to maturity basis higher than the coupon nominal yield? Same as the coupon nominal yield? Less than? Cannot be determined. Don't ever take cannot be determined. I told you that's not the right answer ever, right? Yeah, it's going to be the same. So when we draw a flat line, that represents a bond at par. People don't buy bonds at par very often. What happens is after Ford issues the bonds, interest rates go up or interest rates go down, and the bond is going to change price in the secondary market. And what you're concerned with, if you're going to buy a bond in the secondary market, what you would make by either holding it to maturity or holding it to call, depending on the circumstance of that. Now, as we said, the one thing you've definitely got to be able to do on the test is calculate current yield. And you can't be fumbling around with current yield. And current yield is what an investment pays you. And so this bond pays $80 in annual interest divided by what it costs you. So let's assume now that in the secondary market, you're considering buying this Ford Motor Company debenture for $110. I don't know of any draw on your Series 7 in which they're not going to ask you to calculate the current yield. And so what we're going to do is we're going to take what it pays us and divide it by what it costs us. And on the test, we find out that's 7.3%. That's very testable. Now, with the teeter-totter as a trick, I'm going to show you that we already know that that number has got to be something less than 8. And so we're going to again play this game called interpolation. Now, this bond is trading in the secondary market at 110. So what has happened, test question, to interest rates since Ford issued this debenture? If this is trading at a premium in the secondary market, what has happened to interest rates since this bond was issued? Right on, Logan. Interest rates have gone down, causing the bond to go up. I always joke, if you want to sound like you know what you're talking about and somebody asks you about, economics, finance, or investments, you say it has a lot to do with interest rates. It has a lot to do with interest rates. Now, the other thing that interest rates could do is they could go the other direction. Right. So here we go. And now the bond is trading at a discount. Premium means more than par. Discount means less than par, and bonds trade at a percentage of par. So 90% of par is 900. And again, very testable. Now, before we do the math, I know it's going to be higher than 8. And we do have to be able to do current yield. It's what an investment pays us divided by what it costs us. As I always joke with you, if you can't remember what math to do on your Series 7, divide. And if you can't decide what to divide, take the first number and divide it by the second number. I'd be doing you a service to cover every key on your calculator except the divide key. If you're not dividing, you're probably doing the wrong math. All right, so again, the game we want to play using the teeter-totter is interpolation. We want to be able to get a yield and find a price, not the price, but a price, premium, par, discount, or take the yield and the price and find the yield. Not the yield, but where is that yield in relationship to the current yield and the nominal yield? So that's the game we need to be able to play as it relates to interest rate. After we get done talking about interest rates, we'll talk about credit risk. So here's our teeter-totter and here's our flat line. Now, I illustrated to you that when we buy a bond at par, all those yields are the same. So let's say that interest rates go down and the bond goes up. Now, what's neat about the teeter-totter, and again, that's the game we have to play on the test, is I know that if that's the current yield, I know that the yield to maturity is going to be somewhere in here, and I know the yield to call is going to be down there somewhere. So as I said, what's great is the teeter-totter turns what is judgment questions into aim and shoot, point and click questions. So once again here, what we're going to do is we're going to take the price and we're going to find the relationship, or we're going to take the yield and we're going to find the price. That's the game we're going to be playing. I'm not going to make you crunch yield to maturity. As I mentioned before, there are a lot of legacy test questions out there from the old Series 7. And it drives me nuts that whether it's Kaplan or it's Pass Perfect or STC, sometimes they make you do this number. I have done the number and I'm going to walk you through the number. It's not, can you do this number? The test issue on your exam is, do you know this number is less than 7.3? And, people don't buy bonds for nominal yield and they don't buy bonds for current yield. Most people who buy bonds are already where they're at financially. They're not trying to get ahead. They're just trying to mark time. And so if I'm going to buy this bond, what I'm interested in is, what is my yield to maturity? What would I make by holding this bond to maturity? By the way, the other test implication here is that if I chose to be deceptive, and you got to believe in human depravity and original sin on the test, is I would call you and say, hey, Erica, brand new bonds only pay between 6 and 7. Mine pays 8. And she goes, well, Dean, I think that's kind of an unfair comparison. Don't I have to pay a premium for that? I said, well, geez, you're no fun. And she says, well, Dean, aren't I have a built-in loss here? I mean, I'm going to be buying this bond for 1,100. And if I hold to maturity, Ford's only going to give me back 1,000. So I'm losing $100 over the remaining life. I said, well, gee, you're no fun. And see, Dean, should you really be quoting to me yield to maturity? I mean, really? I mean, I don't think I'm going to get to hold it to maturity. I think I'm probably only going to get to hold it to call because interest rates are down. I think, Dean, you should be quoting yield to call to me. She says, can I talk to your supervisor? I said, ooh, Erica, you're no fun. Right. So one of the things we're concerned with is that we're quoting the proper yield to the customer. Not can we do the math? Now, I'm going to show you here what's called the rule of thumb approximation. The reason they no longer test you on this is people have calculators, they have keys that say YTM. But let's assume that it's 10 years to maturity just to keep my math simple. So I lose $100 over 10 years, that's $10 a year. So I'm getting $80 from the coupon, minus the 10 is 70. So I'm actually getting $70 in adjusted interest. I paid 1,100 for the bond. I'm getting back 1,000. The average price is 1,050. So my yield to maturity approximation would be 6.6. Now, remember, Erica, that's why this is important, because brand new bonds pay between 6 and 7, and so does this one. That's the whole point. So we can compare apples to apples and not apples to oranges. You do not have to do the 6.6. You just need to know where that's at in relationship to 7.3. Let's try it. What is the yield to call number? I've done the math. I'm going to walk you through the math. It's not testable, but ultimately, what is that number on yield to call? Is it higher than 6.6? Is it lower than 6.6? Is it the same as? What is the bond yield to call? It's going to be lower, right? Because if it gets called in 5 years, you're losing $100 over 5 years. That's $20 a year. 80 minus 20, 60, divided by 1050. Now, you may still want this bond, but to decide that, you need to know what is the yield to call, because it's very likely that this bond is going to get called and you're not going to get to hold it to maturity. So one test question is to know that when we buy bonds at a premium, we should quote to the customer yield to call. All right, now what's the other test significance? As I said, the other test significance is, can you know where these relationships are? So remember this game? I'm either going to give you the yield and make you come up with a price, not the price, a price, or a price and make you come up with a yield. That's called interpolation, not testable. Interpolation. All right, so let's try this game. Yield to price. Your customer is considering, let me clean up my drawings here. Your customer is considering buying a bond, or you're considering buying a bond that has a yield to maturity less than the nominal yield. A yield to maturity less than the nominal yield. Is your customer considering paying a discount, par, premium? Cannot be determined. What I tell you about the cannot be determined choice, don't ever take the cannot be determined choice. Yeah, it's going to be a premium, right? Remember the other version of the game? The other version of the game now is I give you the price, interpolation, and I want you to tell me what this number is in relationship to the nominal yield. I say you're considering buying a bond at a premium or bonds trading at a premium in the secondary market. Is which of the following is true? The yield to maturity is greater than the nominal yield. Yield to maturity is the same as the nominal yield. The yield to maturity is less than the nominal yield. Ding, 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 ding. The cannot be determined. As I told you, don't ever take the cannot be determined choice. Now, another thing they might ask you to do is they might ask you to rank the yields from low to high. Rank the yields from low to high. Now, what I love about the teeter-totter, as I said, is it turns judgment questions into aim and shoot, point and click questions. So if we're going to rank the yields from low to high, and this is really important for a bond at a premium, right? So we have our teeter-totter there. And so now we look at a bond at a premium. And we know when we buy a bond at a premium from low to high, it's going to be the yield to call. And by the way, that's very intestable because that's what we should do. And remember this from grade school? Do you remember the greater than, less than signs? So the yield to maturity test question is the lowest yield for a bond purchased at a premium. And that's what we're going to quote. And then it would be yield to maturity. Remember what the fancy word is for yield to maturity? The fancy word is basis. Then it's going to be the current yield. You have to be able to crunch current yield. And then nominal yield. Now, remember this from grade school, by the way. I could go the other way and say from low to high, it's yield to maturity, yield to call, yield to maturity, current yield, nominal yield. But from high to low, it would be nominal, current, yield to maturity. Call. All right, so we've looked at a bond at a premium. We've looked at a bond at par. So if you had to guess what I'm going to show you next, what do you think I'm going to show you next? We've looked at a bond at par. We've looked at a bond at a premium. Yeah, that's right. By the way, of all these scenarios, the one that's the most testable is the bond at a premium, right? That's the most testable scenario. Now, let's say that interest rates go up and the Ford Motor Company debenture in the secondary market becomes less valuable. It's trading at a discount. That's very important, by the way, that relationship that when interest rates go up and bond prices go down or vice versa, very testable. What kind of relationship is that? What kind of relationship is that? Yeah, we assume everybody walking around in the securities industry knows that relationship. And then the same game again, we're going to play interpolation. Yield price or price to yield. So, and again, I love the teeter-totter because the teeter-totter turns aim and shoot point, judgment questions, into aim and shoot point and click questions. All right, so let's look at a bond at a discount. Let's look at a bond at a discount. Boom. Do you have to be able to crunch current yield? You most certainly do. You know, we did this earlier. We take 80 divided by 900 and we get 8.8. We have to be able to do that on the test. You can't be fumbling around with, the math that you're required to be able to do. Now, it's not, can you do these other numbers? You don't have to crunch these other numbers. I'm not talking about test prep vendors. I'm talking about the actual test. It's the relationship that we need to know the yield to maturity is going to be higher and the yield to call is going to be higher still. The game we're going to be playing again is this game of taking the yield and reverse engineering the price, or taking the price and reverse engineering the yield, right? So that's the game we have to be able to play on the test. So I've actually crunched this for you. I've actually crunched the number. And before I do the reveal, is that number there for yield to maturity going to be greater than or less than 8.8? That's the key point. If I crunch that number, indeed, it's going to be greater than 8.8, right? Greater than 8, by the way. I don't even have to have the current yield there, but, I should be able to do current yield. So let's try that first. If a bond is trading at a discount, which of the following is true? The yield to maturity is less than the nominal yield. The yield to maturity is the same as the nominal yield. The yield to maturity is greater than the nominal yield or current yield. Ding, 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 ding. D, choice cannot be determined. What I tell you about the cannot be determined choice. When you're taking your exam, if they ever offer you a choice that says you can't figure it out, don't take it. It is not right. Right? So don't take warm, fuzzy bailout answers. Now, here I have a built-in profit to compensate you for buying a bond that has a lower yield. You know, right now, brand new bonds pay between 9 and 10, and this only pays 8. And so somebody will certainly buy it from you, but they're going to give you a discounted price. And that's the whole point, by the way, is to make apples look like apples and not comparing apples to oranges. So I say, if we buy this bond at 900, we got a built-in profit by holding it to maturity. We're going to make $100 by just sticking around to maturity. You know, to keep my math simple, let's say that's $100 over 10 years. So $80 we make in annual interest, another $10 by just watching it go back to par. That's $90 in adjusted interest. We paid 90, we're getting back 900,000. The average price is 950. And if we do all that math, we get our yield to maturity. You don't have to do it. It's 9.5. By the way, hey, I just said that brand new bonds pay between 9 and 10. And so does this based on this price, which is the whole point. Because, you know, you want to buy the bond based on either yield to call, or yield to maturity, based on what the more likely scenario is. It's very testable. We quote either yield to call or yield to maturity based on whatever's less. That's called yield to worse. Yield to worse. Yeah, I think, Erica, you buzzed me the other day, right? So, you don't dish it out, I can't take it, right? So now I'm not going to crunch here yield to call, but it would be deceptive for me to quote yield to call to you because it's not likely it's getting called because interest rates are higher. So, you know, the point here is that we're going to quote to the customer the lowest yield they could expect, not the highest yield they could expect. You know, the way that we say that as a test issue is we quote yield to worst. And so when we are selling a bond at a discount or par, we're going to quote yield to maturity. And when we're buying or quoting a bond at a premium, we're going to quote yield to call. We're going to quote whichever one of these numbers is the lower, right? So here, the 10.5, if I did the number for you, we don't have to do any of the math, just it's the relationship of the math. But if this gets called, you would be a happy camper because you would actually get 10.5. And that's not likely that's going to happen. I've done the math on these bonds. So I'm just telling you it's 10.5, but that'd be deceptive to tell you 10.5 because it's not likely you're going to get it. Now, again, what they like you to do on the test is know the relationship. And again, here comes the game again, right? We're going to take the yield and do the price or get the price and find the yield. Your client is considering buying a bond with a yield to maturity or basis higher than the nominal yield. Your client is considering buying a bond with a yield to maturity greater than the nominal yield. Is your client considering paying a premium price, par, discount, cannot be determined? What we tell you about the cannot be determined choice. Don't ever take that. You would say discount. Now, you don't need to come up with 900. You just got to know discount. Now, the other version of the game, remember, is kind of the same question. Your client is considering buying a bond at a discount. Is the yield to maturity higher than the nominal yield? Same as the nominal yield? Less than the nominal yield? Cannot be determined, right? And you would say it's higher, right? That is the relationship that is testable. Now, they might ask you to rank the yields from low to high. As I said, I love the teeter-totter because it turns these into aim and shoot, point and click questions, right? So if we buy a bond at a discount, the lowest yield is going to be the nominal yield, right? From low to high, then it would be the current yield. And then it would be yield to maturity, also known as basis. And then it would be yield to call. All right, so that teeter-totter, that's worth some points. We're talking about interest rate risk. And, I highly recommend, listen, it's a buffet. Take what you like, leave what you don't. But if you were considering doing a data dump sheet, if I told you could have one sheet of paper with on it, anything you wanted, what would be on that sheet? I think I would certainly have the matrix. I would certainly have my teeter-totter. Maybe I have some memory aid devices, whatever those may be. And, then when I get a bond question, almost right out of the gate, if I get a bond question, I'm going to draw a flat line, which represents a bond at par, Any question on the teeter-totter before we move on? Very testable. We said we quote yield the worst, right? The lowest yield the customer could expect. And so that means if it's a bond at a discount or par, we quote yield to maturity. Fancy word for yield to maturity is basis. And we said test question. TQ just means test question. So when I put a TQ next to something, it doesn't mean it's going to show up on your draw. As I always joke, right? I'm wishing for you a dream draw. Everything you studied shows up and you go, man, I don't know what the big deal was. But boy, we've had a couple candidates over the last couple, 3-4 days who have reported getting face of death draws. And you got to be, I'm laughing because they were able to take it down, but you got to be able to take down whatever draw you kind of get. I would definitely know that call risk, very testable, is associated with a declining interest rate environment. So not only when you buy a bond at premium do you need to know this idea about yield to call, but you need to know that call risk is associated with a declining interest rate environment. It's very testable to know what is call protection, what prevents the issuer from calling the bonds. Do you guys recall what call protection consists of? My Ford Motor Company debenture didn't have any call protection in terms of price because it was callable at par. But it did have call protection in terms of time. It wasn't callable for 5 years. Well, it's not a put. Put provision is different. It's call risk. Put would be your ability, Erica, to put the bond back the issuer. And that is not as common as a call feature, a call provision. So, there, Erica, in terms of a judgment question, the hardest question to get are judgment questions. But, in terms of judgment question, the call feature is an advantage to the issuer in a declining interest rate environment. And so, Erica, you would expect the bond that has the call provision to have a higher yield and a lower price because that's an advantage that accrues to the issuer. Erica, a put provision, judgment question, is an advantage to you, the bond holder, that allows you to put the bond back to the issuer. And that would be a really nifty thing to have in a rising interest rate environment. And that, Erica, would result in a higher price to you and a lower yield, right? So puts and calls are different things as it relates to bonds. Okay, so boom. As I said, this is really important. So it's not can you actually crunch the numbers? It's do you understand this relationship, right? The only number there that you have to crunch is current yield. You don't have to crunch on the real test. I'm not talking about test prep vendors. I'm talking about the actual test. You don't have to crunch yield to maturity or yield to call. You just got to know where it's at in relationship to the others. So it's that relationship, not the calculation. Well, Cynthia had suggested we put some more performance opportunities in these discussions. And so here is a performance opportunity for you. Why don't you put what you think the answer is in the chat, and then we'll see if you got it right. A bond you're recommending to a customer has call protection. What does that mean? What does that mean? is the number of years into the issue before the investor may exercise. It's the number of years in the issue before the issuer can call. Yeah, there we go. Ding, 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 ding. A sinking fund is a separate thing. A sinking fund is what we call funded debt. I don't think you would see a very low probability, but unfunded debt is where I issue the bonds. So in this case, Ford issues the bonds. This was, $1 billion worth of bonds that Ford issued. Whew. And Ford says, we'll figure it out in 10 years. So in the meantime, they're paying the interest, and then they'll figure out how to come up with $1 billion 10 years from today. A sinking fund is where Ford says, okay, well, let's set aside some money each year so that when the bonds mature, the sinking fund has $1 billion in it, and we have the ability to redeem the bonds. And so that is called funded debt. Ford or that sinking fund can call bonds, tender for bonds. There's things they can do with the sinking fund. I think of a sink, right? We're going to fill the sink up with money, basically. The issuer records the phone number. No. It's B. Okay, so this is very testable. So we said there's two risks in buying bonds: interest rate risk. Wow. And interest rate risk you have in any bond, even treasuries. And then credit risk, the risk that they don't pay the interest and principal, because that's what a bond is. It's the promise. It's my word is my bond. It's a promise to pay the interest and the principal. Now, the one we're concerned with on the test is Standard & Poor's. And we need to know that below BBB, be careful. Below BBB, bonds are less than investment grade. We don't say junk because one man's junk is another man's treasure. But we do say less than investment grade. And these are less than investment grade. The former mayor of Chicago was a guy named Rahm Emanuel. And as the mayor on his watch, Chicago's debt got downgraded from BBB to BB. Uh-oh. Chicago's debt is less than investment grade. And that means they're going to have to pay more to borrow money. There's going to be some fiduciaries. They can't, buy the bonds. And then, Mayor Lightfoot took over and the bonds got upgraded to BBB. Woohoo! Now they're investment grade again, right? So that is a key kind of a thing. It's not single B. Oh, that was the answer to your test. Okay, your practice question, right? So very testable about this credit quality. I wouldn't worry about Moody's. I'd be worried about, again, the BBB versus the BB as a test taker, and knowing, that is investment grade and the other one is not, right? Twitter, the buyout of taking Twitter private, was public and they went private. And in that private transaction, Elon had Twitter issue $10 billion worth of bonds. And so Twitter has, a lot of bonds outstanding. And those Twitter bonds that are outstanding are single B. So that means that Twitter debt is less than investment grade. I don't know how many questions on credit quality or interest rates or bonds as a whole. Lots of questions on bonds. A lot of us colloquially call the Series 7 the stockbroker's test, but if there were, truth in labeling, it'd be called the bond broker's test. There's way more questions on bonds because remember, we have corporate bonds, we have muni bonds, and we have treasury bonds. So you could get 20 questions on munis. And, by the way, these are bond questions in general because this is about all bonds, not just corporate bonds. Tonight's discussion is about corporate bonds, but that's no different. All right. As I said, the other thing we would talk about tonight is the various types of bonds. And corporations can issue secured bonds where they're pledging collateral. They are pledging collateral. So a mortgage bond test question is secured by real property. It's secured by real property. It's not just the building, it's the underlying real estate as well, right? It's kind of like the mortgage on your house. If they foreclose, you don't get to live in a Winnebago on the driveway. The bank gets, the house and the underlying property. Now, it can be open-end where they have no priority provision. All the bondholders are treated as equals, or it can be closed where there are priority provisions. When the Bellagio was built, it makes sense that when back in the day it was Steve Wynn and the company was called Mirage. And one of the major shareholders in the Mirage was Stephen Wynn. And he decides he's going to build, at the time, the world's most expensive hotel resort casino complex. It's going to cost $2 billion. Now, he knows that he doesn't want to issue stock, right? Because if he issues that amount of stock, he's going to get massively diluted in terms of his proportionate ownership. And so instead, the Bellagio issued $2 billion worth of bonds. They did 4 underwritings of $500 million apiece. So first underwriting, second underwriting, third, fourth, and it was open end. And so that means there is no priority provisions. It doesn't matter whether you bought the first bonds or the fourth bonds, everybody is treated the same. Now, if it was closed, we would have called the first bond Series A, the second set of bonds Series B, the third set of bonds Series C, the fourth set Series D, and there would be priority provisions. Meaning, if you own the Series A or 1 bonds, you come ahead of the people who have the Series 4. Collateral trust bonds, test question, are secured by marketable securities placed in escrow. The issuer creates an escrow account, they put the securities in there, and they tell the bondholders that we don't pay interest in principal, we'll either sell those securities or distribute them to you. We'll distribute them to you. Equipment trust certificates, test question, are secured by major movable equipment. And to be major and movable, it should have wheels on it. Again, this is typical of airlines, for example. Now, if you get this on the test, this is simply going to be a recognition style test question. As we said, angels weave for you if you're missing, recognition questions, right? This is just flashcard stuff. You want to make sure you get all the flashcard stuff, you're entitled to. We also have unsecured bonds. So we have debentures that have the full faith and credit of the corporation. We have subordinated debentures. So why would I subordinate my claim to the regular debenture holders? Why would somebody give you a second on your house knowing that they're subordinating the claim to your first note holder? Well, to get more interest, right? So subordinated debenture is when we're subordinating our claim to the regular debenture holders. We have convertible debentures. I may be talking about this one at length in just a little bit. Guaranteed bonds have a cosigner. It doesn't do you any good to have a cosigner with worse credit quality than you have, right? So this is where the parent company guarantees the debt. So, for example, Kaplan is a subsidiary of Graham Holdings, and Kaplan issued $500 million worth of bonds. And Graham Holdings, the parent company, has guaranteed that. They have said to those Kaplan bondholders, if Kaplan doesn't pay you the interest and the principal, Graham Holdings will. Graham Holdings will. Income or adjustment bonds, test question, are used in bankruptcies and restructurings. And, bankruptcies and restructurings really shouldn't be something that Joe Sixpacks invest in. Why would, we don't want our retail customers being involved in distressed securities. And, these bonds don't pay interest unless it's earned. Restructurings. They only pay interest when and if earned. Anybody know what the fancy term for that is? The fancy term for that is these bonds trade flat. And what trade flat means, test question, is a bond that has no calculation of accrued interest. So trade flat. If I say a bond trades flat, That means no calculation of accrued interest. So if you're the buyer of an income or adjustment bond, you do not have to pay the seller any dollar amount of accrued interest. Because remember, the whole point of accrued interest is that you're going to receive a check, and you may or may not, as a buyer, receive this check, because remember, they don't pay interest. Anybody know other bonds that trade flat without calculations of accrued interest besides income or adjustment bonds based on pre-study? Not junk bonds, but bonds in default. There you go. You got it. It's not junk bonds, but bonds in default. So bonds in default trade flat. And that makes sense as well, right? Because if the bonds in default, you, the buyer, say, well, geez, I don't think you're going to get, the money. And the whole point of me giving you a check is that I'm going to get that money 6 months from today. And then you brought it up zeros, right? So those also trade flat. And what that means is no calculation of accrued interest. So, maybe I'm an investor, and the corporation doesn't have any income or adjustment bonds outstanding, but they do have some bonds they're in default on. And so I swoop in and I buy all those bonds, and I'm now the single largest creditor of this corporation. I'm the single largest creditor of this corporation. Let's say Cynthia is the CEO. And so I reach out to Cynthia as the CEO. I say, hey, Cynthia, I have some ideas about how we can restructure this business, this corporation. It doesn't matter to me whether you want to do it on a friendly basis or a not so friendly basis. If we can do it on a friendly basis, that would be better. But, let me lay out what I think we should do. I think you should put Erica on your board and make her a senior vice president. You don't even need to pay her, Cynthia. She has a lot of expertise in distress situations like this. I think she can be very helpful. Make her a senior vice president. And, I'll take care of Erica. You don't need to worry about taking care of Erica. And what I think you should do is exchange the bonds I'm holding for income or adjustment bonds. Instead of the bonds I'm holding that you're in default, I'd like to exchange them for income or adjustment bonds. You don't have to pay me until you get back on your feet and we start to earn some money, which I hope is soon, and then we'll adjust them upwards obnoxiously. And, if we get the business fixed, your stock price is probably going to go up. And so as a sweetener, what I'd like, Cynthia, is some warrants so that I can provide you some additional equity financing down the road and become your single largest shareholder. Right now, I'm just your single largest creditor, but I have a hope that we can, make this work in a way that I can exercise those warrants. Now, they're going to be striked above the current market price, but yeah, I think it could go well. Now, if you don't want to go along for the ride, I'm going to put you into bankruptcy, and I'm going to tell the judge I offer you to a restructuring plan. I'm going to say, hey, judge, I told the corporation that they didn't even have to pay me. They could exchange me for these other bonds. I offered America's services at no charge to the issuer. I'm a long-term person. I wanted some warrants so I could provide some additional financing down the road, and all that. And I got turned down. If I have to do it that way, I'm still going to do it, but I'm going to fire you, Cynthia. And then Erica's not going to be a senior vice president. She's going to be running the company. She's going to be the new CEO. Now, do you want to go along for the ride? Do you want to fight? Don't matter to me. I'm what's called a vulture investor. Vultures are God's creatures too. I'm flying around looking for people that are having problems that I can help fix. Now, the point again is, why would a retail investor want to step in the middle of a gunfight between me and this corporation? So it's kind of counterintuitive. You think, oh, my client needs income, so I should buy an income bond. Absolutely not. Absolutely not. Now, corporations issue zero coupon bonds. As we said, zero coupon bonds, test question, have no call risk. As we said, they trade with no calculation of accrued interest. But one of the disadvantages of a zero coupon bond is you have to do straight line amortization upward. Not going to make you do that on the test. That's called accretion. And what kind of sucks about that is you're actually going to have to pay taxes on money you're not actually receiving. So there's an imputed interest you're receiving on these zero coupon bonds from the accretion. And you have to pay taxes on that. That kind of sucks. What do we call paying taxes on money you're not actually receiving? What do we call that? The idea you're paying taxes on money you're not actually receiving. Right? This kind of sucks. You're paying tax on money you're not actually, receiving. That's called phantom income. All right. So what else you got to do on bonds? You got to be able to know the various types. So here we go with another performance opportunity. Put in the chat what you think the appropriate answer is. Which of the following bonds only pay interest when and if earned? Yeah, B. Very, very testable. Yeah, on the test, I'm either going to ask you to rank securities from senior to junior or junior to senior. This will be, something you need to know in chronological order. Capitalism without failure is kind of like religion without hell. And so, if we liquidate the business, we liquidate the corporation, we sell off all the assets, we pay off all the liabilities. The secured bondholders, test question, are senior. They're the most senior investors in the corporation. And then unsecured and preferred stock. Remember, it's called preferred stock because you have preferential treatment in liquidation. That's what we're talking about now. And dividends. So preferred stock is a senior security only to the common. And then the common, always debt before equity, always, right? Your creditors were not capitalizing a business and taking a businessman's risk. Your owners knew they were capitalizing a business and taking that businessman's risk. So that's why, yeah, your creditors always come first. Common stockholders always come last. Now, there may be a residual claim, after we, pay off everybody, maybe there's some money left. The theoretical liquidation value of the business is known as its book value. Its book value. From junior, senior, it'd be common, preferred, unsecured, secured. RTFQ. Make sure you read that full question. I'm not going to read it to you. I'm going to see if you read it correctly. And it looks like I already got somebody who did not read it correctly. What is the appropriate answer? Upon a corporate liquidation, which of the following debt securities? Which of the following debt securities? Whoa. Right? I'm being a jerk there. Right? If you don't catch that debt, you're very likely to tell me the answer is C and felt very good about it. But that isn't the correct answer because it has debt. It didn't say following securities. It said debt securities. And so that means the answer is not C. The answer is B. Hit the buzzer. All right. So convertible bonds. What are the advantages to a corporation of issuing a convertible bond? It makes their debt more marketable and it lowers the interest rate that they would pay on the bonds. More importantly for us as investors, it gives us the safety of the debt because we're a creditor. And it gives us potential upside of the stock because we can switch our status from being a creditor to becoming an owner. Now, Erica, this was the question you had posed to me. You had a couple of practice questions. I'm going to show this to you. In the indenture, the written set of promises between the issuer and the trustee for the benefit of the bondholders, in convertibles, there's what's called a non-dilutive provision. And what that means is I want my conversion features to be adjusted for any stock splits and stock dividends because it makes sense. I want to be able to convert into the same proportional ownership. If there was a 2-for-1 split and they didn't adjust it accordingly, I would be converting into, half of what that proportion used to be. So, since this represents potential dilution, by the way, the existing owners had to vote in favor of the issuance of the convertible bond because as people convert, their proportion ownership goes down. People may or may not convert because it depends at maturity what the stock price is. I'm simply going to look at the stock price and say, oh, gee, what's worth more to me? X number of shares or my $1,000. So here's an example, Erica, of that question. So this requires us to make an adjustment to the conversion features. So the way I'm going to do that is I'm going to take the existing conversion feature, which here is 25 shares, and here Starbucks declares a 10% stock dividend. So I'm going to take my conversion ratio of 25 shares. I'm going to times that by 10%. And I'm going to find out how many additional shares I'm going to want. And so when I times this by 10%, that's the stock dividend, I find out that what I'm going to want is 2.5 more shares. So we're going to have to adjust the conversion feature here for another 2.5 shares. Now, what they did on the question you sent me, Erica, is they said, what would be the new conversion price? So I have my conversion ratio now. My new conversion ratio is 27.5 shares. And to figure out the price, which is kind of stupid, I think it's a test prep thing because nobody cares in the real world. Nobody cares about, the conversion price, but we would simply take the 1,000 and divide by 27.5, and that would give us a new conversion price. Really? Logan, did you just get the conversion ratio? Usually on the SIE, people just had to do the conversion ratio. Did you actually have to calculate parity on the SIE? Man, that's a face of death draw. Oh my God. Well, that's good debrief. I mean, I just finished an SIE class and I tell them just to be able to do the conversion ratio. All right, so let's take our par and we divide by, I still am behind Eric on explicating your questions, and I'm going to explicate one of these for you. This would be 36.36 would be our new conversion price. It had been 40, but it's 36.36. That's our adjusted conversion. I think it's very, very, very low probability. Again, I think that is more of a test prep vendor thing than an actual test thing. Okay, what you're definitely going to have to do is parity. You can't be fumbling around with how to calculate parity. Either parity of the stock or parity of the bond. Parity means equal. Parity of the bond is when it's equal to the current market price of the stock times the conversion ratio. Parity of the stock is when the stock is equal to the current market price of the bond divided by the conversion ratio. You can't be fumbling around. As I said, if you can't decide what to do, what should you do? What math should you do if you can't decide what to do? You should always divide. Right. So I'm telling you, the division part is actually more testable, more probable than the multiplication part. So common stock price after Starbucks. So Starbucks issued this $40 convertible bond. At the time, Starbucks was 38. And now Starbucks has gone to 50. They've taken the proceeds, they built the business. And so that's certainly going to drive the price of the convertible bond. And it is a bond. So interest rates would also drive the price. And then parity, very testable, is when the value of the bond and the converted shares are equal. And you can't calculate parity without having the conversion ratio. So as I always say, the first thing you should do when you get a convertible question is establish the conversion ratio. So you can't do anything with this $40 here. What you got to do is figure out how many shares you can have. And the way you do that is you take par, because the conversion terms are based on par. You divide by the conversion price, which in this case is 40, and you get the conversion ratio of 25 shares. So that's the first thing. You got to make sure that you actually, know that that's what you need to do. So here's some examples of this. So here is our Starbucks 6% convertible debenture. And by the way, 6% is more than the common stock pays you. Right? So that's another reason you're going to get some income here. And the test question is calculate the bond parity if the current market price is 50. So what should this bond be worth as a minimum? At what price is the bond equal to the stock at 50? It's not going to be equal to 50. So that's why it's important, because we need to figure out what the equal number is to decide whether or not we want to buy the bond. So the way we do that is we take the stock price, of 50, we times it, that's given on the test, by the way, they would give you the 50. You times it by the conversion ratio. That may or may not be given to you. Remember, you might have to figure that out by, taking par and divide by the conversion price. We did this and we found out the conversion ratio was 25. So parity is when the bond's 1250. Now, typically, the bond would be trading for more than that. I mean, if it's trading for less than that, arbitrage opportunity. So typically, it would be a little bit of a premium. So let's say I bought the bond when it was originally issued for $1,000. And when I bought the bond, the stock was 38, and now the stock is 50. And you're considering buying my convertible bond. And you say, Dean, what did you pay for it? I say, none of your damn business. It's not what we're here to discuss. Right now, the bond I'm sitting on is worth at least $1,250 because it's convertible into 25 shares of a $50 stock. And you say, well, it could go down. I said, well, you don't believe that, or you wouldn't be here talking about buying my bond. You're asking me to leave the party early, and it's a happening party. So I'm going to we would expect this to be trading at, and I would want a premium to that $1,250. We would expect it to be trading now at something more than that. So here's the other scenario on the test. It's trading for $1,300, 130. And remember, you can switch your status. You can turn this bond into the stock. You can go from being a creditor to an owner. This is the more likely test scenario. So now we're going to take the bond price, which is $1,300. We're going to divide by the 25, and let's do it on our calculator. I say, if I buy the bond at $1,300 and it's convertible in 25 shares, parity would be 52. So my minimum expectation is that Starbucks is going to go to 52. Right now it's 50, right? But parity is 52. If you don't think it's going to 52, then you shouldn't buy this convertible bond for $1,300. So I don't know of any draw on the test in which you're not going to have to calculate parity. Taxation of corporate debt. It's taxable at all levels as ordinary income. You might have to do a suitability question about whether somebody should buy a taxable bond or whether they should buy tax-free. Should they buy a 4 to 8% taxable bond or a muni? And there's the formula for doing that. We did a separate class, a separate lecture on munis. But remember, sometimes you have to determine suitability. Zero coupon bonds, we said you have to do straight line amortization upward called accretion. And we said you're going to be paying on interest on money you're not actually receiving. Capital gains, if you buy the bond low and you sell it high, will be based on how long you've held the bond. So to qualify for a long-term capital gain, how long do you have to hold the bond for? Or in any investment for that matter. Cynthia, are you here still? I hope you're not in the waiting room. It's telling me people are in the waiting room. All right. Yeah, I hope you haven't been out in the waiting room this whole time. Are you here, Cynthia? Oh, good. Okay, great. Jeez. I'm going to redo the settings so that the waiting room is not enabled. And that way you guys can just come into the class without going in that waiting room so I don't accidentally leave you out there. Okay, so boom. I think we got it pretty close to an hour on this one. Any questions? Let me take this down. Boom. Anybody have any questions about what we've discussed in this a little over an hour? I'm trying to get these things to be somewhere near an hour. Sometimes we run over. You have any questions for me about corporate debt or anything else? Yes, no, everybody's cool.
I have a quick question, Dean. Cynthia here. Just wanted to ask, when it comes to parity, will we get a question where they may ask us, like, what would we pick rather, for example, the example that you had, whether it's a 52 or whether we should go with the other, or would it be more of just the calculation itself?
I'm sorry, say it again, Cynthia.
Yep. The example that we had for the parity of a bond, parity of stock, I should say. As far as a test question, would it be more of the calculation, or would it be maybe would
More
it be
often
the
than not, it's a straight calculation about parity, but again, it depends on your draw. So,
Mhm.
let me give you a hellacious one. Let's see if I still have my. So this is intellectually the same question. So this is intellectually the same question. There's the particulars.
Mhm.
Can you see the slide?
Yes.
So let me just put that up there. So just reminding you that I'm about to give you the same question, but I'm gonna camouflage it substantially. Are you ready for the most hellacious convertible question you could expect?
Yes.
And like I say, if you're operating from abundance, maybe it's not to scarcity. Eric, I am happy to do that. If you could put the QID in the chat, I'll try and bring it up and do it. I don't have here. I have a pile of stuff here. So if you want to do that, just find it, the QID, and I'll bring it up and we'll do it together if you'd like. We're officially done. So in these overtime things, you're welcome to hang out if you'd like. All right. So here we go. A convertible bond is trading at a 30% premium to par. A convertible bond is trading at a 30% premium to par. It has a conversion price of 40. If the common stock is trading 2 points below parity, if the common stock is trading 2 points below parity, what is the common stock trading at? Oh my God. So let's just break it down as component parts. A convertible bond is trading at a 30% premium to par. So par is 1,000 times 30%. And that means the bond is trading at 1,300 or 130. It has a conversion price of 40. What I tell you about conversion price?
That's how we get our conversion ratio.
Yeah, you can't do anything with that, right? So we got to take the 40. We said the conversion price is 40. So let's put that there. And we got to reset that based on par because that's where the terms were set, right? When the bond was at par. And so that's our conversion price. And so now we're going to take par and divide that. And we're going to find out that divided by that is 25 shares. So, we're way through this thing. And it says, okay, so your client is considering, are the convertible bonds 30% premium to par? It has a conversion price of 40. If the stock is trading 2 points below parity, so that means I'm going to have to figure out what parity is. And a point in a stock is $1. So 2 points below that number, I have to solve for that number. And so now we're going to do what we did previously. Like I say, it's the same question, just a lot of stuff going on. Right. And so now we're going to take the 1,300. We're going to divide by 25. And then we find out that parity is 52. And what is 2 points below that? Remember, that was the question. And you would tell me that on the stock, that means the stock is at 50. Right. That's the current market price because that's 2 points below parity. So that's about as hellacious as I think it can get. The other thing that comes up, Cynthia, sometimes is they ask you whether your client should accept a tender for the bond, $1,000. This is called a forced conversion, or whether they should convert. And that's pretty easy to do. I mean, here, for example, Cynthia, if they offered to call the bond or tendered for the bond at 1,100, you shouldn't do it, right? Because it's worth at 1,250.
Mhm.
Right. So that's another one where you have to make a decision. I would expect you to get at least 2 questions on convertibles. And I can't imagine that you don't have to calculate parity at least once.
Mhm.
Right. All right. So the QID, let's bring up a QID. This is the adjustment I told you. As I mentioned, this is more of an issue for, the test prep vendors than it is actually for, the actual exam. And let me bring up, this is a Kaplan QID, and we'll bring it up. Let me get back to you guys. Can you guys see my screen? You guys see the Kaplan screen? Yep. Okay, good. All right. So this is, let's get this over here. And so this is Erica found this question. And so let's put it up here, 128, 2903. All right. So a corporation has an, let me make that bigger so people are checking in on the replay. Usually what I do on these is like, I put them like this so you can't see the answer set. But a corporation has outstanding an issue of 8% convertible bonds with a conversion price of 25. Can't do anything with the 25. What do you need? The minute you get the conversion price, what do you have to establish? The conversion ratio. That's very important. So we stop, we do the conversion ratio. We take 1,000 divided by 25. We have a conversion ratio of 40. You see how I got the 40? I took the 1,000 divided by 25. The bond indenture contains an anti-dilutive clause. As we said, I want to be able to get into the same proportion. So what I'm going to do again, Erica, is just like the one I showed you when we were doing class, is I'm going to take the 40 shares. How'd I get the 40 shares? That was the 1,000 divided by 25. I'm going to times it by 10%, because that's the adjustment I need to make based on that stock dividend. And that means I'm going to want 4 additional shares, right? Because that's where I'm getting the 4. And that means I want to be able to convert into 44 shares. And then again, what they're kind of getting at is this relationship to par. And so now I'm going to take my par, right? Par's 1,000. And I'm going to divide that by 44, the adjusted conversion ratio. And I get 2273. Any question about how I did that? The second one is very similar. So let's get rid of this. Come on, Dean. All right, so our next one was 128, 2902. By the way, I got to get my little Kaplan commercial. If you don't have a Kaplan Q Bank, you can get a Kaplan Q Bank with a 10% discount using Guru 10. You know, that's the commercial, so we can, use Kaplan content. Anyways, an investor owns a convertible debenture with a conversion price of 10. What do you got to do the minute you get the conversion price? Test question. What do you got to establish? You can't do anything with the conversion price. You need the conversion ratio. So what you're going to do is take par, 1,000, divide by 10, and that gives you the conversion ratio. So again, now if it's a 10% stock dividend and my conversion ratio is 10, I'm going to adjust my conversion ratio accordingly. So 10, that's my ratio, times 10%. And that means I'm going to be able to get 1 additional share is what I'm going to want. So my new conversion ratio is 11 shares. And now I'm going to take my calculator. I'm going to take 1,000. I'm going to divide by the adjusted conversion ratio, and I get $9.09. So there you go. I showed you 2 of them. I don't think, Erica, you're going to see either one of them on the actual test. All right. Anything else you want to talk about before we call this session over? Anything else? All right. Well, remember, inch by inch, your Series 7 is a cinch, yard by yard. Series 7 is hard. We don't have any classes on the schedule for the next quarter yet because we are finishing up our first quarter. I haven't done equity securities, which is the, well, you'll be able, Erica, to find it in the video. I just did the video, so it'll be in the video. So you can just, I'll send you a copy or it'll be up on the playlist here shortly. And you can watch me go through it. So it's been recorded. Anything else before we call it a night? Send me any suggestions you have about start times. Anything else you want to see in a class, these evening classes, about an hour or so? I'd be interested in your thoughts. Remember, if you're new, anybody new with us? Is this your first time, Nick? Is this your first time participating with us? So Nick, just so you know, you now qualify for free office hours. So Nick, if you go to the schedule, what's on there is office hours that are free, and they're for people who have paid for either tutoring or a class like this. And if you want to register, that's available. And there's a free live stream. And then Nick, the other thing, Logan, are you the winner? Are you the winner of the drawing, or did you pay? Well, I'm not gonna make that distinction, Logan. So same thing for you as well. I'll treat you as if you were a paid alumni. The other thing, what I wanted to share with you is that means on the caps. So for example, live stream has a cap of 10. The cap doesn't apply to alumni. So if for some reason, I'm telling you there's a live stream and you can't see it, it's because once there's 10, it automatically removes it from the schedule. And I'm more than happy to put you in there if you'd like to participate in a live stream, the overtime session that we do not every Tuesday, but we typically do after our live stream. Anything else? You need what early next week? I think I have it there. Don't we already have? I think there's an office hour, Erica, that you're already in, I think. And I think there's a couple open spots. I think that's next week, is it not? I think it's like Wednesday. What I typically do is I open a new one when that one's full. So when the office hour disappears, that means it's full, and then I open up another one. All right. Well, as I said, I'll see you next time. And, if you have anything, remember, you don't have to wait around for a class. You can send it to me. The email is deantheseries7guru@gmail.com. And I'm more than happy to make you a video explication or, answer your question. All right, everybody. I'll see you next time. Bye-bye.
Take care. Thanks, Dean.
You bet. You bet.